Let's face it, you aren't Jeff Bezos, but if you are, hi Jeffrey. But since you aren't, you'll most likely need to retire eventually and live off of some sort of passive income. Most people work all of their lives, save a portion of their paycheck, invest that, and over the course of 40, 50 years, use that, earn money to retire, and just... The problem with that is you're not Jeff Bezos, but if you are, leave a comment. So you clearly don't have enough saved to live off of until you expire. What if I told you there's a little hack you can start using today to set you up for your financial future? And the best part is you won't even have to lift a finger. Because let's face it, you're not Jeff Bezos. If you are, please comment. So what exactly is dividend investing? Dividend investing is an investment strategy that focuses on purchasing shares of companies that distribute a portion of their profits, also known as dividends, to their shareholders, you and me. These dividends are typically paid out on a regular basis, sometimes semi-annually, sometimes quarterly, sometimes annually, and they serve as a way for companies to share the financial success with its investors, you and me. When you invest in any stock, you become part owner. When you invest in a dividend stock, you become part owner, plus you get paid. As that owner, you're entitled to a share of the company's profit. So instead of solely relying on capital appreciation, the increase of the stock price over time, dividend investors seek to generate income through consistent dividend payments. Should you invest in dividend companies? We're gonna get right into that. But what determines if a company is a dividend company? I'm glad you asked. Companies that engage in dividend investing often have a track record of stable earnings, strong cash flows, and a commitment of returning value to their shareholders, you and me. They're usually well-established, mature businesses in sectors like utilities, consumer goods, financial services, which all tend to generate steady profits over the long term. It's companies who are not on a huge growth record. Think more of Coca-Cola, who is generally known for its dividend payment. So if you're an investor looking to get into dividend payment, this is what you should prioritize. Prioritize a company with a history of reliable and growing dividend payments. Yes, companies can slash their dividends quarterly, annually, monthly, weekly. These investors analyze certain financial metrics. Here are a few important ones. We have the dividend yield, which is the dividend per share divided by the stock price. The dividend growth rate, which is the annualized rate at which the dividend payments increase over time. And payout ratio, which is the percentage of earnings paid out as dividends. So how does exactly a company determine what percentage to give out as dividends? They take all of the revenues, they minus all of their operating costs and everything that's involved in running a business, and whatever's left over as earnings, a percentage of that goes out to you and I as shareholders. So now you might go out right now, go buy some Coca-Cola and expect hundreds of millions of dollars in returns in dividends. Not quite. I'm gonna walk you through a real life example of what you can do today and start generating that passive income through dividend investing. Let's go. So there's three things we want to look at when determining if a company should be worthy of our money to receive dividends. We're going to go ahead and look at that price to earnings ratio. Coca-Cola, as you can see, is looking at $60.39 as of June 6th at 3:17 p.m. Our P to E ratio is 26.61. For PepsiCo, we're looking at a price to earnings ratio of 38.24. So a little bit better than Coca-Cola, but that's not all we look at. And then of course for Keurig Dr. Pepper, its direct competitor, we're looking at 33.5. So just because price per earnings ratio is a little bit lower end does not mean that's all we look at. We have two more factors that we look at, so let's go look at them now. Now the next thing we look at is that dividend payout ratio. Now how do we calculate that? We're gonna go ahead and take that yearly dividend per share and divide it by the earnings per share. What does this look like? I got you. Come on. For Coca-Cola, we got 46 cents per quarter per share. So we're gonna take 46 cents and divide it by 4. We get 184. And divide that by the earnings per share, which is 2.27. And we get a dividend payout ratio of 81%, which is actually fantastic. When we do the same for Pepsi, we get over 100%, that's kind of the top end. And when we do the same for Keurig Dr. Pepper, we get 0.20 times 4. So remember, it's 20 cents per share per quarter. So multiply that by 4, we get 80 cents per share per year. And divide that by the earnings per share, and we get a dividend payout ratio of about 86%, which is also pretty good. And the last thing we want to look at is that dividend growth ratio. Just because it's over 100% this year does not mean next year it'll be the same. So let's go ahead and take a look at that historical trend and let's see what it looks like. So if you go directly to Nasdaq.com, I'll provide the link in the bio. We see exactly what the annual dividend is, when they'll pay it out, the dividend yield percentage, the price to earnings ratio, and you can use all these to come up with several different formulas to calculate exactly kind of what you want. So we can go all the way back to 1995 with 22 cents per quarter per share. And then we just keep going, it keeps going up, 14, 16, 17, 18, 20, 25, 28, 30, 34, 40, 41, reaching right about 51, 2012. It just kind of sank again and then just kind of restarted. And now it's pretty much back up to almost an all-time high. So what does that show you? Show you that it goes up, it had a reset, and it's now just going back up. Good. or let's go check out Pepsi. All right, with Pepsi, again, you can see all the same information here. Let's go back to 2000. So we have here at 14 cents per quarter per share, going all the way up to about 51, 70, 90, a dollar, over a dollar, 126. So it looks like Pepsi is just kind of a straight vertical line all the way up until very last payment, which was actually a couple days ago. So that's really good news. Let's go look at Dr. Pepper. All right, Dr. Pepper, back to starting at 2009, we got 15 cents per quarter per share, rising all the way up to about 103. This is interesting. Definitely have to look into that. This might be an error here. But essentially, it kind of just dropped back down to 15 cents, 18 cents, 20 cents. Looks like we reached the peak and just kind of had this weird thing going on here, and then started pretty much back at 15. So it looks like it's going back up, but again, you never really know with these dividends what could happen. You could have a dividend payout of 58 cents, and then 3 months later, a dividend payout of 103. I'll just fact check that, and I'll leave a comment or something in the description with a correction up on there. All right, so here's all the data points that we have with the price to earnings ratio, the dividend payout ratio, and the dividend growth rate all here. Now it's your responsibility to determine what fits your investment strategy better. In this case, I really like Pepsi for their dividend. It's much higher than all the other ones. The price per earnings ratio is pretty good. All the ratios were much higher than the other ones. And Dr. Pepper, I'm still kind of on the fence with that whole $103 dividend payout. But anyways, those are the 3 stocks that we analyzed today. I hope that you can value this going forward. You can see exactly what dividend stocks work for you and what could be useful for you in the future. Also, bonus tip, if you want to get really fancy, look at that dividend growth rate and compare it to the rate of inflation. If it's better, it's a good investment. If it's not, it might not be the greatest investment, and there might be better options out there. Also, make sure that the price of the stock is not overvalued too much, and determine if in the future your investment will actually make sense. That's all I have for you today. If you found this video helpful, leave a comment down below, subscribe, like, ask me any questions you have down in the comments, and I will try and do my best to get to them. All right, peace.